At this time, I'd like to turn the conference to Ellie Kinmetter. Please go ahead, ma'am.
Thank you, Matt. Good morning, good afternoon, and welcome. I'm Ellie Kemeter with Foley and Lardner, and I'm pleased to welcome you to today's web conference. In this program, we address tax compliance procedures for tax-exempt bonds. Why does the IRS want them, and what should issuers do? I'd like to take a moment to introduce our program speakers today. First, we have Mike Bailey. Mike is a partner with Foley and Lardner, and his practice focuses on public and healthcare finance. Second, we have Meredith Brooks. Meredith is an associate with Foley and Lardner, and her practice also focuses on public and healthcare finance. Before I turn the presentation over to our speakers, I'd like to go over a few housekeeping items. Today's program will last approximately 1 hour, followed by a short question and answer session. If you experience problems with Adobe Connect, please call 888-569-3848 for technology assistance. For audio assistance, dial star, then 0 on your telephone to reach the operator. Today's program has been set up in both a discussion and an interactive question and answer format. We encourage you to submit written questions during the program. Type your question into the question and answer box at the right-hand side of the presentation slides. We will respond to written questions and also take live questions at the end of the program, time permitting. To ensure you get the most out of today's presentation, we encourage all participants to maximize the PowerPoint to full screen usage. You can do so by clicking the full screen button located above the slides. The PowerPoint presentation will be available on our website at foley.com by early next week, or simply click the Download Files button along the right side of your screen to get a copy of the slides today. As a reminder, today's program is being recorded and will be available on Foley's website by early next week. Foley will apply CLE credits after the web conference. If you did not supply your CLE information upon registration, please send an email to Ellie Kemeter at EKEMMETER@foley.com. As a final note, those seeking New York and New Jersey CLE credit are required to complete the attorney affirmation form. A 5-digit code will be announced during the presentation. Please email this code to Ellie Kemeter at EKEMMETER@foley.com. And now I would like to turn the presentation over to our speakers.
Thanks, Ellie, and thank all of you for joining us today. I want to provide a roadmap for what it is we're going to discuss. Our goals are sixfold. We want to identify the actions the IRS is taking to encourage the adoption of tax compliance procedures and help issuers and borrowers determine what type of tax compliance procedures are best for their organizations. We're going to highlight some of the practical benefits and disadvantages of different compliance procedures and discuss the policy questions issuers and borrowers should consider in developing their own procedures. We're going to consider the special procedures that are advisable for certain types of bond issues, and finally point out what future actions you can expect from the IRS. And with that, I will turn things over to Mike.
Okay, thanks Meredith, and thanks to all of our participants for joining us today. Before jumping into all of the details, we thought it would be helpful to provide some general background and of where the IRS actions are coming from. And a major theme over the past several decades has been an increased emphasis on tax-exempt bond requirements that apply after the date of issuance. When I started in the public finance practice way back in 1982, it was widely thought in most cases that tax-exempt compliance depended on just expectations as of the date of issuance, and there wasn't a great concern with actions that occurred after the date of issuance. And in broad sweep, of course, in the 1980s, the code was changed, among other things, to impose the rebate requirement. So the 80s largely brought about legislative requirements that required actions after the date of issuance related to investment of bond proceeds. So, for example, the rebate requirement was generally imposed. And in the 90s, I'd say in broad sweep again, requirements related to use of bond proceeds were imposed by the service, in this case mostly in the form of regulations which said that tax compliance depends not only on date of issuance expectations, but also deliberate actions taken after the issue date. Another part of this story is that before 1995, the IRS really didn't have a tax-exempt bond compliance or enforcement program. When I was at the service in the 90s, I played some role in setting that program up. But after I left, the service organized the formal tax-exempt bond compliance program, and so-called TEB. And that program stood up in 2000, and it really is a much larger organization within the IRS than the lawyers and chief counsel. And I'd say one of the great themes in the development of the rules relating to tax-exempt bonds over the past decade has been the increased prominence of so-called TEB, these administrators at the IRS as compared to the lawyers. And really, the administrators have a much larger group. They have 70 or 80 personnel within TEB as compared to roughly 10 lawyers at the IRS. And they've really started to run the show. Now you may say, well, it's better that lawyers aren't running the show anymore, but this whole set of initiatives we're talking about is really coming from the administrators, the so-called commissioner side at the IRS, and it's not so much coming from the lawyers. And that kind of puts in perspective what many of these initiatives are about, because most of them are not actually legal interpretations of the law. They're administrative promptings by personnel at the IRS who aren't lawyers. And Meredith is, so in addition, the IRS has implemented a real enforcement program, as many of you know, as a part of this tax-exempt bond compliance program. And as a part of that, there's been a great emphasis on the sort of administrative power that the IRS has in the context of IRS examinations. And one of the reasons to take these messages from the administrators of the IRS seriously is indeed how things play out in an enforcement context, and in particular, the all-or-nothing nature of most tax-exempt bond requirements. Because in most cases, either a tax-exempt bond issue is entirely tax-exempt or it's entirely good. So even minor violations can technically result in non-compliance. And when an issuer is presented with a case that it may have violated the rules in some minor way, it has very little negotiating power with the IRS, because the IRS can always threaten to declare the entire bond issue taxable. So in our experience, and we've dealt with the IRS and many controversies, that establishing good faith with the IRS has a number of practical benefits. Very few issuers and borrowers really want to go to the mat at a controversy with the IRS. And in many cases, it's easier to work out favorable settlements if there is a problem, if you've established good faith compliance. So a part of what we're talking about with these administrative procedures is just getting the practical benefits from establishing good faith with the IRS. Of course, we're also going to talk about some benefits in addition to what the IRS has been addressing in these various initiatives. And one of those is that the tax-exempt bond rules are increasingly complex, and the approaches of many issuers to comply with them have not always kept pace with the complexity. And we recommend that issuers and borrowers should consider some issues that really haven't been raised yet by the IRS. So now Meredith was just going to walk us through some of the specific initiatives that the IRS has taken in this area. And I did want to emphasize that we have prepared a white paper on this subject which walks through these various administrative actions in some detail, and the link to that white paper is available at the end of this presentation. So Meredith?
Thanks, Mike. As Mike mentioned, there are the administrative procedures and actions through which the IRS has emphasized its focus on tax compliance procedures. And these administrative actions can be seen across a spectrum. So at one end, you've got the active, direct, and regular information returns of the various Forms 8038, and for 501c3 borrowers, Schedule K to the Form 990. At the other end of the spectrum, there are the less regular and, in some instances, passive publications and IRS postings to the website. In the middle, there are the compliance check questionnaires and the statements and questions asked in IRS examinations. So if we start at the beginning of the spectrum and work our way through, there are two questions on the Form 8038. Do you have written procedures to ensure remedial action of non-qualified bonds? And do you have written procedures to monitor the requirements of Section 148 of the Code, the arbitrage, rebate, and yield restriction requirements? And while Schedule K to the Form 990 only applies to 501c3 borrowers, it is the most detailed of the information returns. But its detail isn't necessarily indicative of its comprehensiveness. There are more questions that in theory could be asked on the Schedule K, but haven't been to date. In August of 2011, the service revised portions of its Internal Revenue Manual procedures that deal with how penalties are assessed under the Voluntary Closing Agreement Program, or VCAP. Prior to August of 2011, penalties in VCAP were assessed from the date of the violation. But with the new revisions, if an issuer or borrower has implemented certain written tax compliance procedures that meet minimum requirements that we'll talk about a little bit later, that issuer or borrower is eligible to have their penalty assessed from the date of discovery of the violation, or at least the date that it should have been discovered. And in some instances, that can lead to a pretty sizable reduction in the amount of a settlement. Since mid-2000s, the IRS has been distributing compliance check questionnaires that are related to qualified school construction bonds, advance refunding bonds, BABs, government bonds, and qualified 501c3 bonds. There are statements within those compliance check questionnaires that are directly related to post-issuance compliance as well as issue price. So the potential exists for questions asked in the compliance check questionnaires to, in altered form, find their way into the Internal Revenue Manual procedures. As we move further along the spectrum, there are the statements and questions that are asked in IRS examinations that are related to compliance procedures. And in April of last year, the service set forth its recommendation for tax compliance procedures in its publication 5005, Your Responsibilities as an Issuer of Conduit Bonds, and then the various postings to the IRS website that relate to tax compliance procedures. So the overall picture here is that the IRS has done anything and everything it can think of short of legally requiring that issuers and borrowers adopt tax compliance procedures to evidence their interest in the subject and encourage people to adopt them. We understand that issuers and borrowers are more likely to respond to the information returns at one end of the spectrum because they are regular and required, but taken as a whole, all of these administrative actions indicate where the service is going and to what elements they think are important for a tax compliance procedure.
Okay, well, thank you, Meredith. And just to elaborate a little bit on what Meredith says, what we're trying to do is to sort of make sense and decipher these various different types of administrative actions the IRS has taken and how to respond to them. And, you know, again, these actions for the most part aren't sort of legal interpretations of the law. And when you look through the sorts of questions the IRS has asked in these various different vehicles, they're not always consistent. They've evolved over time. They continue to evolve. The questions sort of aren't set in stone in the same manner words would be in a regulation. So which of these different types of guidance is most important to focus on? Now, as I say, there's no legal requirement that issuers or borrowers actually adopt post-issuance compliance procedures. There are, however, some legal requirements that relate to to compliance procedures. And of course, record retention generally is required for taxpayers. But there is some ambiguity about how that requirement applies to governmental issuers and borrowers who may not be taxpayers in the ordinary sense. And of course, there is a legal requirement that issuers issuers and 501c3 borrowers file with the service certain information returns. And there's certain information in those information returns that are required by the code. But all of the questions we're talking about relating to post-issuance compliance procedures are in addition to anything the code requires. And the IRS has a great deal of latitude in asking additional questions, and we expect they will ask additional questions in the future. So most of these compliance actions really are, if you will, informational in nature, and they're intended to prompt issuers and borrowers to respond by adopting these procedures. And Meredith was going to talk a little bit about best practices, reasons to consider adopting these procedures in addition to what the IRS has raised so far. So Meredith?
Thanks, Mike. So as Mike said, there's no legal requirement for these procedures, but as a best practice, they allow issuers and borrowers to avoid mistakes and oversights, better coordinate date of issue bond documents with their ongoing compliance requirements, and provide a better and more efficient record for refundings. They're going to allow issuers and borrowers to take advantage of favorable IRS rules and clarify the roles and responsibilities of individuals within your organization, while at the same time setting expectations for professionals outside of your organization by clarifying their roles and responsibilities as it relates to your bond issues. For 501c3 bonds, it makes Schedule K reporting just that much easier. So hopefully we've convinced you of the need for tax compliance procedures absent a legal requirement, and Mike is going to talk to you about what different types of procedures you should have.
Thanks, Meredith. Well, of course, there are a wide variety of different types of tax-exempt bond issues and issuers, and the size and sophistication of the bond issues also vary dramatically. So I think the IRS has recognized that there's no one-size-fits-all for all different types of tax-exempt bond issuers and borrowers. But I will say that much of the administrative guidance, at least currently, is drafted in a sort of one-size-fits-all approach. For example, the questions in the Form 8038G and Form 8038 are the same for all different types of bond issuers. So the question in the 8038G about tax-exempt bond compliance procedures applies to the most complex state financing, and it also applies to a small school district financing. The same question is asked, even though you would think reasonably the tax-exempt procedures for those two types of issuers would be much different. So we believe that it makes sense for an issuer to ask some questions before really thinking about what sorts of tax compliance procedures it wants to adopt. And one is the IRS has indicated that issuers can get at least some administrative benefit by adopting these procedures. And which of those benefits does an issuer want to get? And what benefits may it want to get in addition to what the IRS has specifically indicated so far? So what are the real goals? What is the complexity of an issuer's bond issue? You know, more complex bond issues generally would merit more complicated and detailed procedures. Whether there are sort of unique legal requirements that apply to at least some of an issuer's bonds, and whether those legal requirements should be addressed in procedures. And of course, the organizational structure and resources of an issuer and borrower, and also, importantly, cost. So Meredith is going to talk about 3 tiers of approaches that we've identified that have different benefits. And what we want to do is to try to compare the benefits you get from these various approaches to the cost in adopting them. So Meredith?
So we've essentially broken this down into those 3 approaches: a bare bones approach, an intermediate approach, and a best practices approach. With the bare bones approach, we're going to make the assumption that most issuers want to be able to check the boxes on the information returns. And this is because the IRS has indicated that not checking the boxes increases the likelihood of audit. So the components of a bare bones tax compliance procedure would, at minimum, contain procedures to meet the requirements of Section 148 of the Code and procedures to ensure that all non-qualified bonds of an issue are remediated. So those are two small boxes, two seemingly innocuous questions, but there are a few things that an issuer or borrower should consider. Procedures to monitor the requirements of Section 148 of the Code could reasonably include any number of things, from a fair market value assessment, a determination of the frequency of rebate computations. Procedures could establish the timing for when you obtain a rebate consultant and identify the amounts treated as gross proceeds, along with identifying amounts subject to yield restriction. Procedures could establish the issue price of bonds, and we'll get into a little bit more detail about that later. They could include procedures related to swaps and the certification of professionals. They could cover advance refunding escrows when investments other than slugs are permitted. And they could contain restrictions or requirements relating to working capital financings. So in a bare bones set of procedures, you don't have to address all of these things, but they are questions and issues to consider as you're tailoring your procedures to your organization. Because bond finance property can only be used for qualifying purposes, you need to monitor that usage. And bare bones procedures allow you to check that second box on the 8038 and say that you have procedures to ensure that all non-qualified bonds of an issue are remediated. That entails having a process for identifying the use of proceeds limit that applies to your particular type of bond issue, whether it's 10% for government bonds or 5% in special circumstances. Your procedures would also identify the person who's responsible for monitoring the use of bond finance property, and also designate someone who's responsible for taking remedial action as it relates to the use of that bond finance property. In the context of a bare bones approach, issuers and borrowers should consider that each different type of remedial action has its own set of requirements. So whether that's redemption, defeasance, alternative qualifying use, whether you're going to need an opinion of bond counsel, and whether you should even seek VCAP for your issues. So there are many more requirements for bonds other than those covered by the Form 8038. But at the bare minimum, a bare bones procedure would include what's necessary to check the box on the information return. And as Mike mentioned before, the IRS has the power to at any point change or expand the questions that are asked in the 8038. The bare bones approach serves as the foundation for the other two approaches to tax compliance procedures. And Mike's going to talk about the intermediate approach.
Yes, thanks, Meredith. And we dwell a little bit on the bare bones approach because, we view this as being the likely sort of minimum foundation of tax compliance procedures that any issuer and borrower would want to adopt, so that you'd at least get the benefit of being able to report to the IRS that you had adopted procedures that meet these two particular questions that are raised in the Forms 8038. Now, as Meredith mentioned, there's also favorable treatment provided under the IRS administrative procedures, the so-called Internal Revenue Manual, which is basically the internal manual for the IRS. And this is not a manual which has any binding effect on any other taxpayers or issuers. It just describes the service's administrative procedures. And recently, within the past year, this IRS has significantly amended its procedures for its voluntary resolution program. So if an issuer violates the tax-exempt bond rules and isn't able to self-correct as permitted under the regulations because it doesn't act promptly enough or some similar circumstance, the IRS has a very flexible program for issuers and borrowers to go into the IRS and resolve the noncompliance by entering into a closing agreement and preserving the tax-exempt status of the bonds. So the second approach we're talking about is really responding to those manual provisions that the IRS has put out. And what they really said was, if you adopt certain types of tax-exempt bond compliance procedures, if you do have a problem and you do need to come in to talk to us, we may give you a better deal. And one thing they said is, we will treat a violation as occurring only when you reasonably discover it, if you have adopted these procedures, and not when the violation actually occurs. So for example, the violation won't occur when bond finance property is sold to a for-profit person. It may occur at some later date when the issuer actually reasonably discovers it. And of course, the IRS usually measures the settlement amount based on its lost taxes, or the so-called tax exposure, from the date of the violation. So this is one instance where, at least if an issuer has a problem, it may get a much better deal if these procedures are adopted. So we have described in some detail what the IRS requires to get this type of favorable treatment if you need to go in and resolve a problem with the service. And we're highlighting certain elements for this voluntary resolution favorable treatment that are in addition to what's required in the specific questions in the Forms 8038. So what this literally says is that an issuer gets this favorable treatment if they identify the officials responsible for monitoring compliance, describe the training provided, describe the frequency of compliance checks, which must be at least annual, describe the nature of the compliance activities, describe the procedures used to identify and evaluate the resolution of the violation. It requires certain procedures for record retention and evidence of the awareness of this voluntary resolution program that the IRS has. Meredith, you were going to give us an example of what kind of benefit an issuer could get from adopting this sort of intermediate approach compliance procedures.
So Mike spoke generally about the benefit available to adopters of an intermediate type approach. So in real terms, that looks like this. So say in 2005, a city issues $100 million of tax-exempt bonds at 4% interest at par to finance a single building and no other assets. In 2012, the city adopts compliance procedures that meet the requirements of the intermediate approach. And a year later, the city leases half of the building to a for-profit entity for the remainder of the term. So let's say in January 1st of 2014, the city discovers that the building was actually bond financed and seeks a voluntary closing agreement with the IRS. And as Mike mentioned, the settlement is going to be based on the tax exposure. So in this instance, that's about $1.16 million a year, the equivalent of $4 million of interest on the bonds times the tax rate for the entire bond issue. The tax exposure for the non-qualified bonds is about $515,000 a year, or the 1.16 million times the amount of the bond issue that's not remediated. So if you adopt this intermediate approach type compliance procedure, you are eligible to reduce your settlement amount by at least $515,000, which isn't an insubstantial amount if you consider the fact that if the violation had taken place earlier, the amount of the settlement could have been even higher.
Okay, and I was going to highlight some of the additional requirements for this intermediate approach that are in addition to what is asked for in the Forms 8038. And one is that to get this favorable treatment, an issuer has to have procedures that require compliance checks at least annually. And that could be particularly burdensome and costly for some issuers. For example, to have a use monitoring requirement that applies every year could be very burdensome, say for a small school district or even larger issuers. There's a specific requirement for training that's not mentioned in the Forms 8038. And that's not likely to be too burdensome, but it is additional requirement that needs to be addressed. And then these additional requirements in the IRS manual do talk about record retention and other procedures, which at least would need to be put into these tax compliance procedures in order to comply and get the favorable treatment. And I would like to emphasize that neither the Form 8038 nor these additional questions really ask all of the questions that are relevant to tax compliance. these are just a few of the questions and elements that the IRS has focused on so far. And in many respects, it could be anticipated the IRS will ask more complete questions in the future, and they may not ever ask all the questions that are relevant. And with that, I'd like for Meredith to talk about the third approach, that is our so-called best practice approach.
So this last approach, the best practice approach, accomplishes both the goals of the bare bones approach, allowing you to check the box on information returns, and the goals of the intermediate approach, which allow you favorable treatment under the procedures related to VCAP. So what the best practice approach does in addition to those things is allow issuers and borrowers to take advantage of favorable IRS rules, like correcting expenditure mistakes, and better coordinate the roles of participants in your bond transactions, whether that's your counsel, your financial advisors, bankers, or your internal staff. And of the three approaches, the best practice approach provides the greatest protection against mistakes and has the added benefit of a longer shelf life. And this is because it anticipates what the IRS may want or includes more than they've asked for in the information returns. So in the event that you ever need to, the likelihood decreases that you're going to have to constantly update your procedures simply because they're forward-looking. All that being said, the best practice approach isn't without its disadvantages. Mike mentioned that it could be more time-consuming and certainly more costly. I think as we look at all three approaches, one way to sort of separate them out is that the bare bones approach and to some extent the intermediate approach are focused on avoiding noncompliance. But the best practices approach takes advantage of favorable IRS rules and is more proactive and anticipatory of the potential questions that the IRS could ask or the elements that could be included in tax compliance procedures. We're not going to go into a ton of detail here, and as Mike mentioned, the white paper dives a little bit more into these issues, but there are procedures that are common to all three approaches, but there are certain instances in which they differentiate themselves. So one thing that all three approaches, best practices, intermediate, or bare bones, are going to do is determine what portion of your bond issue is an issue for tax purposes. They're going to address the arbitrage and rebate requirements, and they're going to monitor the use of bond finance property and require certain record retention provisions and identify the individuals responsible for monitoring them. Where the intermediate approach and best practices approach differentiate themselves is, as Mike mentioned, with the at least annual monitoring of bond finance property, their training requirement, and the acknowledgement of an awareness of VCAP as an option for your organization. The best practices approach has additional procedures that essentially allow an organization to take advantage of favorable treatment under the IRS rules. And this is a pretty gross simplification of what these procedures contain, but I think it's important to help us sort of suss out what the benefits are to the different approaches. So as we said, each builds upon the next. All three procedures are going to allow you to respond favorably to the information returns. They are going to go further in helping establish in good faith that you are seeking to comply with this tax procedures requirement or suggestion if you ever find yourself in an audit situation. And simply by having procedures, whether they're bare bones or intermediate or best practices, you're going to avoid some compliance mistakes. The biggest difference between the bare bones approach and the intermediate and best practices is that the last two approaches make you eligible for favorable treatment in VCAP. And the best practices approach has the most benefits, almost by definition. It takes advantage of those favorable rules, and it clarifies the responsibilities of individuals inside and outside of your organization. And because it is forward-looking, doesn't need to be updated all the time. So we've kind of addressed these procedures in an off-the-rack fashion. Mike's going to talk about the questions and issues that you should consider as you tailor these approaches to best suit your organization.
Thanks, Meredith. There are a number of policy questions an issuer should consider in framing these procedures. And of course, one is, at what level should they be adopted, at the board level or by specific officers. We focused in particular on the level of completeness of procedures and which is best. And by that, in the vernacular we've used, for example, a bare bones approach, an intermediate approach, or a best practices approach. And that it really is a policy question. I mean, how complicated do you want procedures to be to get certain benefits and weighing that against the cost? Because, for example, an issuer might really want to be able to respond favorably to the Form 8038 information returns and reduce the risk of audit, but it might determine that it's not necessary to be able to qualify for this favorable treatment if it ever needed to go in and resolve a problem with the IRS, because it would think it might be remote that it would ever have a problem that would need to be resolved. Or in the case of a very complex bond issue, an issuer might want to have best practice procedures just because of the complexity of the rules and the benefits of being able to take advantage of the favorable rules that are in the IRS regulations. Of course, a basic question is which departments, officers, or other functions within an issuer or borrower should be tasked with tax compliance responsibilities. And in many cases, particularly with small issuers, you may have one officer, a CFO, for example, who may be responsible for all of the tax compliance procedures. In other cases we worked with, for example, large cities or states, it may be that there are really different functions responsible for different sorts of tasks. And there may be one function or officer who is responsible for investing proceeds, another for monitoring how property is used, and yet a third for keeping records. And all of that needs to be sorted out in developing compliance procedures. There's another sort of basic framework question of the scope of these procedures. Do they apply to all of your bond issues or just some of them? And that means both scope in time and also in scope and type of bond issue or transaction. So one issue that's often raised is, do you want the procedures just to apply going forward for new bond issues, or do you want to bring all of your existing bond issues into compliance with these procedures? And if you do that, how far back do you want to go? And we have various different dates that we suggest should be considered for going backwards. For example, in the case of 501c3 bonds, because there's more detailed reporting required for bonds issued after 2002, it may be reasonable to consider going backwards to all bonds issued after 2002, but not necessarily prior bond issues. But that's a basic policy decision. And then, should the procedures apply to all types of bond issues or just certain types? It may be difficult, at least as an initial matter, to draft procedures that really respond well to all different types of bond issues. So one approach might be to start writing procedures, for example, for general obligation bonds, and then move on to other types of special revenue bonds in the case of a governmental issuer. Meredith, you were going to address procedures that we believe are particularly recommended for consideration that aren't raised expressly in any of the IRS administrative actions.
Thanks, Mike. I would say the procedures that we're recommending but aren't necessarily mandated are project spending review, a reallocation of bond proceeds, the documentation of equity contributions to bond finance projects, and a determination of issue price. The regulations permit an issuer or borrower to correct or change how bond proceeds are spent if they take action on a timely basis. Project completion review or a bond proceeds spending review can help make sure that the favorable rules are used to their full advantage. Since it's important to account for bond proceeds from the date of issuance to the date of expenditure, a best practice approach would be to detail the accounting framework you're going to use in the reallocation of bond proceeds and identify the fund or the account that'll be deemed to hold bond proceeds in the event that a reallocation leads to a delay in expenditures. There are proposed regulations that allow an issuer or borrower to associate the portion of a project used for a private business use with the portion that's financed with qualified equity. And qualified equity is equity not derived from tax-exempt financing. So that means having record retention procedures, procedures to identify the project or projects that are financed, in part with tax-exempt bond proceeds and in part with qualified equity. And we've mentioned a couple of times throughout the presentation issue price. And issue price is defined as the amount that an issuer is deemed to receive from the sale of bonds, and it includes any compensation that the issuer pays or is deemed to have paid to an underwriter or a placement agent. As we mentioned, in the compliance check questionnaires, the IRS has indicated that it's a best practice for issuers and borrowers to actually review the pricing information on EMA or retain a professional to do that, and to look beyond the certifications that are delivered to determine the issue price of your bonds. This becomes particularly important for advance refunding bonds if the advance refunding escrow is invested near the bond yield, or for tax credit bonds that aren't permitted to be sold at a substantial premium. Mike, I think you were going to talk about some of...
well, Meredith, I'd just like to elaborate a little bit on this list of particularly recommended elements for compliance procedures. And of course, the first three of these are really procedures that are intended to take advantage of favorable IRS rules. And the so-called project spending review, there's this very favorable IRS regulation that actually says you can change how the bond proceeds are spent within 18 months after a project is placed in service. So basically, even after you've spent the bond proceeds and may have dispersed them for actual requisitions, you have a period of time to correct mistakes. And we believe it's particularly important that issuers think about taking advantage of that very favorable rule. It's basically a rule to correct spending mistakes. Now, to a limited extent, the only place this is really addressed is the Schedule K for 501c3 bonds, which has a question that says, have you made a final allocation of bond proceeds? And that question is really referencing in an indirect way this favorable rule that gives an issuer a period of time after it's actually dispersed the bond proceeds to change how the proceeds are spent. Now, when you really think about it, though, to actually reallocate or change how the bond proceeds are spent can be a little bit more complicated than meets the eye. So as Meredith was saying, to have a framework for how it works when you actually spend the proceeds can change how the proceeds are spent can be very helpful because, for example, if you change how the proceeds are spent and the expenditure of the bond proceeds is delayed for a few months, the bond proceeds have to be deemed to be someplace. So we recommend that an issuer at least designate a fund that would ordinarily hold funds for capital projects, so it will at least be deemed to be holding those bond proceeds. So that's kind of a technical point, but just walking through how this favorable rule actually works, we think is an important element. Now, this documentation for equity contributions to bond finance projects can be maybe the most important thing to simplify issues that may arise with respect to private use, because basically the so-called equity contributions to a project can soak up the amount of private use. So if you can document, if you finance a building and the building has 20% equity or non-bond financed contribution, you can basically have an additional 20% bad use, but only if that's documented. Now, the last one, the determination of issue price, is not necessarily a favorable rule, but we add it because at least 4 of the compliance check questionnaires, including the advance refunding compliance check questionnaire, the Build America bond questionnaire, the questionnaire for qualified school construction bonds, ask detailed and elaborate questions regarding determination of issue price. And we know it's been a big focus of the IRS. So of all the requirements that aren't currently expressly in either the IRS manual or the information return forms, I think one of the most likely to be added is issue price. And we know that the IRS is very focused on procedures related to issue price, so we recommend that those procedures be considered, even though they're not currently required to get any of this favorable treatment as an administrative matter with the IRS. Now, we also wanted to talk about special procedures for different types of tax-exempt bond issues. And it is the case, as we've noted, that to a large extent, the IRS has sort of taken an approach in the information returns, sort of a one-size-fits-all approach, just because of the nature of the information returns that apply to all different types of issuers. And we've developed, and many other counsel have developed, standard sort of off-the-rack compliance procedures that address basic elements like arbitrage and private use and so on. But in our experience, it may be the unique requirements for particular bond issues that are more likely in real practice to cause compliance problems. And we recommend that an issuer think about its types of bond issues and identify the issues that may be most likely to cause non-compliance if they're not monitored. And an off-the-rack approach to compliance procedures won't accomplish that goal. So we've listed a few examples here just to give you a flavor of the types of special issues that might not be addressed in sort of form off-the-rack compliance procedures. And one is, in recent years, it's been the case that many governmental issuers, states and large cities in particular, have issued long-term bonds for essentially working capital, or they're treated as working capital bonds for tax purposes. And many of these large bond issues have specific provisions or tax covenants that say on an annual basis, if the issuer has a surplus, it will use that surplus amount either to buy back the bonds, or in some cases buy other tax-exempt bonds, or in some cases specifically yield restrict any surplus amount. And there's been actually quite a large volume of these long-term working capital bonds that have been issued, and many of them have these covenants which require surplus to be used in a particular way, sometimes framed differently by different bond counsel. And that requirement, that tax covenant requirement to use surplus to buy down bonds or otherwise use that surplus for special purposes, usually would not be addressed in any form tax compliance procedures. But indeed, for those long-term working capital bonds, it's by far the most important tax issue. And indeed, it's one that might be overlooked 5 or 6 or 7 years hence when nobody has been paying attention to the specific requirements in a tax agreement or certificate that's buried in a bond volume. Another example is for qualified 501c3 bonds, there's a specific requirement that 100% of the bond proceeds be owned by a 501c3 organization or a government. And in our experience, it's actually this ownership requirement which is most likely to cause non-compliance for many 501c3 bonds. Anytime you have a 100% requirement and there's no de minimis rule that permits you to make small mistakes, there's a great potential for non-compliance. And I will note that the Schedule K that asks specific questions about tax-exempt bond issues really doesn't ask an express question of whether 100% of the bond proceeds continue to be owned by a 501c3, which is really in many cases the most likely issue of non-compliance. For Build America bonds, the special so-called direct pay bonds that were issued under the Recovery Act, there's a 100% capital expenditure requirement. And again, anytime there's a requirement of 100% and there's no relief for small non-compliance, there's a considerable risk that there'll be some footfalls. So for Build America bonds, it may be particularly important to have rigorous procedures really to review all of the expenditures to make sure they really are treated as capital expenditures for tax purposes. One other example we have dealt with at some length with different issuers are tax increment bonds. And in many cases, these are bonds which are treated as tax exempt mostly because they're treated as payable from taxes of general application and not from any private payments by developers or otherwise. And in many of those bond issues, really the key tax issue is that a developer or another person doesn't enter into any arrangements which would cause the bond issue to have private payments. That does not affect the treatment of the payments for the bond issue as being only, say, property taxes of general application. So for those types of bond issues, really the key compliance issue may be monitoring any sort of special arrangements with a developer or private person to make sure that the developer isn't making any payments. So these are just some examples of how, for particular types of bond issues, it really makes sense to focus on what the real tax compliance issues are that are most likely to raise possible problems. And now, for one moment, we'd like to pause for a CLE message. Ellie?
Thank you, Mike. So at this time, I'd like to announce the 5-digit code for those seeking New York and New Jersey CLE credits. So that code is QJ2JN. Again, this is a code for those seeking CLE credit in New York and New Jersey. And one more time, the code is Q as in Quincy, J as in Jack, the number 2, J as in Jack, and N as in Nancy. Thank you, Mike.
Thank you, Ellie. And we wanted to conclude by trying to sort of see around the corner and anticipate future developments and what future initiatives the IRS may take. And as I indicated at the outset, most of these IRS initiatives aren't in the nature of regulations or other so-called published guidance. They're really administrative actions taken by the IRS. They're changing questions in form. They're changing how the IRS internal revenue manual procedures are stated. And just as a practical matter, it's much easier for the IRS to change those forms frequently than it is to rewrite a regulation. So in many respects, these IRS actions, just because they aren't sort of legal, formal, published guidance, but just administrative acts that are being taken by the IRS, it's easier for the IRS to change them frequently. So for example, it's a much less elaborate process for the tax-exempt bond program at the IRS to change the questions that are asked in these information returns than it is to change a regulation. So I'm anticipating actually that there will be significant changes in these administrative actions and that it will be a fluid situation going into the future. So to give you some specifics, now, as we've noted, we've been talking just today about these IRS initiatives apply to all different types of bonds. And of course, there are specific requirements that apply to different types of bond issues, but we thought it was helpful for all issuers to give sort of an overview of what the IRS is doing. And one example of that is the so-called Form 990, the information return for 501c3 organizations in Schedule K has elaborate questions related to post-issuance compliance, and actually they're quite burdensome. They ask for the amount of private business use to the nearest tenth on an annual basis, for example. And so far, that approach has not been extended to any governmental bonds. Now, of course, it's a different situation in some respects because the IRS has express authority to require exempt organizations to file annual information returns. But it doesn't have express authority for governmental issuers to make annual compliance returns relating to their tax-exempt bonds, except for the Forms 8038 that have to be filed on the date of issuance, and the Forms 8038T that may need to be filed if a rebate payment is made. But there is one instance with governmental bonds, at least right now, where issuers are required to file annual information returns. They're not really information returns, but annual returns, and that is for the Build America bonds, where issuers are receiving direct payments. Issuers have to file for each interest payment the so-called 8038CP. And so far, the IRS has not asked elaborate tax compliance questions in the 8038CP, but they could do so. And if they wanted to, they could incorporate part or all of the approach that they're currently using in the Form 990 Schedule K to add specific tax compliance questions in the 8038CP. So I would expect they wouldn't do that in a wholesale basis initially, but that they might start asking some more specific tax procedures compliance questions in the 8038 CP in the future. I'm expecting also that, right now the questions that are asked in the Forms 8038 really are limited. They don't address all different types of tax-exempt bond requirements, and that it would be very easy for the IRS to expand the types of tax procedures questions that are asked in the current 8038 forms. So I have no information that they're planning to do that imminently, but in the future I would say there's a significant likelihood that would happen. And then IRS actions to provide additional favorable treatment for issuers that enact compliance procedures. I will say I had the honor of serving on the so-called advisory committee to tax-exempt and government entities at the IRS, the so-called ACT, which is the advisory committee set up to deal with the portion of the IRS which deals with state and local governments and exempt organizations. And in 2009, I was the primary author of a report basically that proposed to the IRS that just as a safe harbor, if IRS adopted certain procedures with favorable, with basic elements, compliance procedures, it would get favorable treatment. And one of the main themes of that report was that issuers would get much more liberal and favorable treatment dealing with record retention than they would if they didn't have compliance procedures. So the IRS so far in its manual has just said, well, you can get better treatment if you come in for a voluntary closing agreement if you have these procedures. But there's any number of other favorable things they could do. For example, record retention relief, making it easier to qualify for de minimis exceptions to rules and so forth in the future. And I would not be at all surprised for the IRS to expand the favorable treatment that it will afford issuers and borrowers in an administrative manner in its procedures in the future. Meredith, you were going to talk a little bit about some takeaways from our talk.
So what have we learned today? Essentially, you have a lot of options. The IRS has said in any number of ways that procedures are important, but for your purposes, there are some questions you're going to have to ask yourself. What type of bonds do you issue most regularly? How large is your organization? How did you come down on some of those policy questions Mike discussed earlier? And you're going to have the ability to tailor your procedures to best suit your needs. So whether you choose a bare bones approach or an intermediate approach or best practices, sitting down and taking the time to sort of sort out what's most important to your organization is going to benefit you in the long run. So in the event that you just didn't get enough in today's presentation, Mike's going to let you know what we have coming down the pipeline.
Thanks, Meredith. So we view this in the first of a series of webinars we're going to offer on tax compliance procedures. And the white paper that we've prepared sort of is the foundation piece for that series. It sort of lays out where the IRS stands on the basic approaches for responding to them. We want to drill down or how to respond for different types of bond issues, as we've touched on some today. The next one we're going to offer is going to be completing the Form 990 Schedule K, and this will be sort of a nuts and bolts review of the specific questions the Form Schedule K asks and how to respond to them, and also putting the Schedule K in broader compliance and how it fits in with the financing approaches of issuers and how it fits in with their compliance procedures generally. Now, that is generally of interest only to 501c3 organizations and conduit issuers of 501c3 organizations. But for the reasons I've set forth in our talk today, I think it also could be of interest to governmental issuers, because some of the questions which are currently asked in the Form 990 Schedule K could be translated by the IRS into questions for governmental bonds in the future. Also, after that, we propose to present seminars on different types of bonds, particularly governmental bonds, and we invite your comments and questions about what topics would be of most interest to you. So again, I'd like to thank all of you for joining us today. And now, Ellie, we'd like to turn it over for any questions.
All right, great. So operator, at this time, we are ready to take participant questions if there are any.
Thank you, ma'am. If anyone on the phone would like to signal at this time, please press the star key followed by the digit 1. Again, for our phone audience, if you'd like to signal, press star 1, and please be sure your mute function is off to allow that signal to reach our equipment. Currently no questions in queue, but again, it is star 1 if you'd like to signal.
All right. Well, then if nobody has any questions, we just want to thank you very much for joining us for the web conference today. As Mike alluded to, a copy of the white paper, Tax Compliance Procedures for Tax-Exempt Bonds, Why Does the IRS Want Them, and What Should Issuers Do, can be found by using the link shown on the screen. And bound copies are available upon request. Just a reminder, today's program is being recorded and will be available on Foley's website in the next few days. If you have questions regarding CLE for this program, please contact Ellie Kemeter at ekemmeter@foley.com. Please take a minute or two to give us your feedback about the presentation today using the link on the screen. It's important for us to know your thoughts and it helps us shape our programs going forward. And finally, we invite you to contact any of today's speakers if you have additional questions or would like more information on their particular topics. And thank you very much for your participation.
Again, that does conclude today's call. Thank you for your participation.